Hello everyone, welcome to Accounting 210. In this video, I will review chapter 11 with you and then we work on the multiple choice. So let's look at our textbook. Chapter 11 basically talking about one important thing is the standard cost, and then how do we break down our flexible budget variance to two parts based on the direct material, direct labor, and then variable manufacturing overhead and cost fixed manufacturing overhead. So I'm not going to go through the textbook each page, but I make sure you read the textbook because I think our handout is very similar with our textbook. I just summarized kind of some formula for you to do all of the calculation. But read textbook, first thing is what are standard costs. We didn't really do individual, like I didn't focus too much because we wanted to focus on the calculation in class. So make sure you read textbook 654. And then as I say, later when we get the variance, all of the variance, when we get all of the variance, make sure you read the textbook. Make sure you read the textbook, like page 662 kind of tells you which department you should look for if you have favorable variance here, unfavorable variance there. So how do you interpret the results? You got favorable, you got unfavorable, but what does that mean? What are we doing good, doing bad? Should we promote this manager? Should we fire that manager? Remember, the whole purpose of doing variance is to evaluate your managers, right? So make sure you read the textbook. So in this video, I just I made the notes already. Sorry, I kind of found my notes, so I just use this black and white page to print. Personally, I think those are the things you want to make sure you understand. So what are the standard costs? I'm not going to say too much, but they say it's just in your active my accounting lab assignment there. And then main thing is how do we do all the calculation? How do we do all the variance for our cost of our goods sold, for the direct material, direct labor, manufacturing overhead? And then for manufacturing overhead, you have a variable, you have a fixed. So we put the first three together because they are variable costs, direct material, direct labor, variable manufacturing overhead, they are all variable costs. So they share the similar logic. Remember from chapter 10, we said this is your actual, left side is always your actual, and then your master budget is on the right side. And then we put flexible budget in the middle. So difference of actual and flex budget, we call it the flexible budget variance. And then difference of flexible budget and the master budget, we call it the volume variance. The total difference, we call it the master budget variance. So chapter 11 break down our flexible budget variance to two parts, either price variance or quantity variance or different names. But first thing is about the dollar. Second thing is about the quantity, the units number. So I kind of made this one. I said for each overall number, you have to use your units, use the quantity, use the machine hour, use the labor hour. So that is some hour, some quantity, some pounds, some square feet, times the dollar amount for each unit of your direct material, direct labor, variable manufacturing overhead. So you always have those two items. Make sure the unit is the first, the dollar amount is the second. So it's actual times actual as the actual. Standard times standard on the right side. And the actual units times your standard dollar amount gives you the middle. So the difference of AA and AS, you can find out that they use the actual quantity, they use the actual units. The only difference is just you use the actual price or standard price. So we call the variance as price variance, rate variance, and then we say you have to make sure it's favorable or unfavorable. How do you decide favorable or unfavorable? if your actual operating income is better than your budgeted operating income, that's favorable. That's favorable. But we are looking at the costs, right? So if your actual cost is more than your budgeted cost, then your actual operating income will be lower than your budget operating income. So you will be unfavorable. Look at the AS and the SS. So they share the same standard price, but the difference is just the units, the quantity. So we call it quantity variance, efficiency variance. Okay, and then this is just for variable cost. For the fixed manufacturing overhead, you use your actual, use your standard, but in the middle is your budgeted fixed manufacturing overhead. And we say it's important to make sure you know how to interpret this fixed manufacturing overhead had volume variance. How do you interpret? If it's unfavorable, that means you didn't produce as many volume as you thought. You thought you will produce 300 units, you still produced 200,000 units. So you didn't produce the volume as you thought. That's the reason you have an unfavorable volume variance. So if it's favorable, that means you thought you will produce 300,000 units, you produce 500,000 units. So you have a more volume than your budget. So you have a favorable. And then make sure you read the advantage and the disadvantage of using standard costing from your textbook. Okay, so instead of I can work on each one also here. I don't know which method you like. You want me to just go through important thing or want me to do every question with you? Let me know what you like. But the first page, those questions are just a review of previous chapters. It's not related with the chapter 11. Sales is very similar with sales is similar with revenue, right? So earning profits, they are not sales. Purpose of budgeting, we said, is to plan, control, and this, and then this is from your chapter 9, I believe. Next one, goal concurrence, we said, basically is your manager and the CEO, they are the same. My interest is my parents' interest. Nobody will sacrifice. So if you manager do something, that will also benefit the company. Difference between flexible budget and the master budget is, we said, flexible budget, why it's called flexible, it uses the actual output. Master budget uses the budgeted output. Master budget master budget use your expected output. Flexible use actual output. Managers tend to do this. We didn't talk about in any chapter, but you just need to know. Managers, they tend to manage what they will be measured, right? If you are measured on the exam points, then you will try to get more points in the exam. If you are measured by the assignments, you will try your best to get more points of your assignments. So the same managers, they will to manage what they will be measured, Okay. Next one, which of the following? So now we are talking about chapter 11. The advantage of standard costing is that it's not advantage. Use a performance benchmark, that's right. Use basic for component, that's right. Simplify of bookkeeping, that's right. Changing behavior manager to observe desired variance. This is not correct. So from your textbook, I put my here is at page 667. You use this method, you may have what's the word is that, unintentional, something like that. So make sure you read your textbook. I told you this is one disadvantage actually of using the standard budget, of using your standard. Unintended behavior consequences this is your disadvantage, right? Okay, next one. One level of common flexible budget, this total cost is this. Okay, what is the total cost of product of this? Okay, so let's look at flexible budget. Okay, flexible budget is you use your actual output. The actual output is 8,000. So when you have 8,000 total cost was $38,000. Was total cost was $38,000. Raw material, direct labor, and variable manufacturing overhead at this. Okay, okay. So when you had 8,000 units, the variable costs should be okay. So your direct material, direct labor, and variable manufacturing, they are variable costs. So your total variable cost is 1.5 plus 2.5 plus 0.5 for 1 unit. You had 8,000 units. So this one, sorry, I should have the number. This one is 1.5, 2.5, 0.5, 4.5, right? 4.5. And then we time 8,000 units times 8, oh, sorry, 4.5 times 8,000 units. So that gives you 36,000 variable cost. Your total cost is 38,000. So this is your variable cost. Your fixed cost will be 2,000. Am I right? Your fixed cost will be 2,000. Total is 38,000, variable 36,000, fixed will be this. I'm now asking you about if you have 8,500 units. So your variable cost will be 4.5 times 8.5 thousand now. 4.5 each time 8,500. So gives me 38,250 plus my fixed cost. Your fixed cost will not be changed, right? Your fixed cost will still be 2,000 plus this 2,000. So that gives 40,250. 40,250. Okay. This is not related with the chapter 11, but kind of something. And the next one, material price variance. Material price variance is the responsibility we said is the purchasing manager, marketing manager. Look at your textbook. I put the thing you need to look at here. Read your text. I'm not going to show you. I want to save time. Look at your textbook by yourself. Material quantity variance. Material quantity. So this is your production. It's the same as I look at your textbook. Okay, make sure you really know how to interpret the number. Why might it be okay to have an unfavorable material price with a favorable material quantity as long as the overall is favorable? So what's the meaning? Is your price is unfavorable, you are paying higher price, but the quantity variance is favorable, so you use them at a higher efficiency. And then, so let's say your price variance maybe is $2 unfavorable, but your quantity maybe is $3 favorable. So overall it's $1 favorable. You paid a little bit higher price, but you get a good quality. So you save the quantity, and overall you still save money. So it's okay, right? They are bringing higher quality material. That's the reason it's a little bit more expensive. But you have a lower waste. That's the reason you have a better quantity variance. So overall, it's still favorable. This is related with your textbook 662. I said make sure you understand the logic with the textbook and then think about this situation. I think it's a very good one to understand the numbers. Okay, next one, question 11, talking about manager purchase a better quantity from a slightly higher price. However, as a result, less spoilage. So it's similar with our last question, right? The effect on the price. So it's that you purchase a higher price so that you will have an unfavorable price, but you will have a better quantity because you have a less spoilage. So you will have a favorable quantity, right? Favorable quantity. So price will be unfavorable, that will be favorable. Answer is C. Question 12, talking about price variance. When you have price variance, it's A, and AS, right? Price variance. Let me see. Okay, we look at this price variance. Okay. Standard quantity between. Okay. then prices during the month you purchased and used this material. So you used the 600 units. When I put it there, I also put it here. And the actual price is 2.25. My standard price is $2. So I will have actual is 2.25, standard is 2, so I will have an unfavorable. Will be 600 times 2.25 minus 2, so will give me, I don't know, 150 unfavorable. Will be 150 unfavorable. Let me check my answer. Yes, 150 unfavorable. So this is how I will do the question if I was in the exam. I put the same when you see the units of material, you put the same there. Actual price, budgeted price, actual price is more, so it definitely will be unfavorable. You get this number. Next one, asking about material quantity. Quantity is AS and SS, right? So your standard price is $2, so you just put $2 there. Your actual quantity you use is 600 units. Standard is you produce the 310 finished products, and then each one you need 2 units of the material, right? You need 2 of the material. So you thought you should use material 620, but you just use 600. So you will have a favorable. So it will be 600 minus 620 times 2 will give me 40 favorable. I got 40 favorable. I don't know what you got. Okay. And then next one, page 14, question 14. Let me see how many questions. Page 14, talking about the labor efficiency. So it's AS and SS. Sorry, I suppose you already read the question. So your standard price is $16, and then actual you used 4,600. Standard is you are making 200 units, and each one is 2 hours. So you thought you will just use 4,400, but you use 4,600, so it's unfavorable. 6 minus 4 times 16 will be unfavorable. Will be this number unfavorable. Did you get that one? You got that one. And then 15, talking about the labor rate is AA and AS. Actual labor is okay. Actual labor hour is 4,600. Actual price is $15, but your standard is $16. So you get a good deal, right? You thought you have to pay $16, but you paid $15. So you have a good deal. It will be favorable. So 46 times 15 minus 16 will be this favorable. Did you get the answer C? Okay. Make sure you know what's the meaning of those numbers. You are paying lower price. You are paying the lower rate, right? You have better bargaining power or something. But maybe you get a lower quality of the employee, so you pay lower price, but they may spend more hours. So you have a favorable rate, but you have a low efficiency variance. And then direct labor price variance unfavorable, much larger. Like, so what should be best position to explain? So the direct labor price, so it will be the human resource and the production. So this is your textbook, as I said, is your textbook there and here. Make sure you read your textbook. Which of the labor variance is most important to determine for the efficiency? When we talk about the efficiency, efficiency is the quantity, right? Rate is about the price, efficiency is the quantity. Next one, well, labor quantity variance will be the production service supervisor. Okay, make sure you read the textbook one more time. Read textbook. Which of the various variable manufacturing is most important to determine efficiency? We say efficiency is about your quantity. Variable manufacturing quantity variance. Quantity variance is always your production. Quantity variance is always your production supervisor. Okay, question 21, you don't need to worry, sorry. Question 22, formula, I don't ask you formula honestly, but if you think the formula helps you to get the numbers correct, feel free to memorize, but I'm not going to test you formula. I'm not going to test you formula. I'll just let you do the numbers. Okay, formula we said rate, variable overhead rate. So rate is price, so it's AA and AS. Actual, so will be actual hour time the actual price minus standard price. Actual hour. So it will be actual hour, actual rate standard. Did you get answer A? You get answer A. Question 23. Oh, we're almost done. Question 23. Which of following is true regarding fixed overhead and the volume variance? This one we didn't talk about. I put it that this is your textbook you need to read. But at least you need to know for your fixed overhead volume variance. So we said if it's favorable, that means our actual volume is more than the standard volume. If it's unfavorable, our actual volume is smaller than the standard. So that is all you need to know. At least if you look at that one is so if production volume is less, then you will have an unfavorable. This is wrong, right? It's favorable. Is less, you will have an unfavorable. This might be correct. Is more, is favorable, might be correct. More than is favorable. So either B or C. If in the exam, I'll just ask you this part. But this question answer is B. So don't worry about the first thing. Don't worry about the first. But you need to know it will be unfavorable. It will be unfavorable if your actual is less than anticipation. Question 23, direct material price variance. As I said, I'm not going to ask you the formula. So the answer is B. I'm not going to read it. I'm not going to do it. If it helps you, just go ahead. You have all the formulas in the textbook. But I'm not going to ask you in the exam. Which of the following is not true? Not true with a fixed manufacturing overhead budget variance. Fixed overhead budget variance. Fixed overhead budget variance. I need to think about what is a fixed overhead budget variance. You can even think, remember, say even myself. Sometimes I don't remember. Fixed overhead budget variance is the difference of actual and then budget. It's the difference of actual and budget. Okay, so difference between actual and budget. This is correct. It's different between budget and the standard. No, this is called volume variance. Okay, can be favorable, unfavorable. It's called also spending. So answer is B. Is not correct. Answer is B, not correct, because it's asking not correct. Volume variance, we said volume variance is only for fixed manufacturing overhead. The volume variance is only for fixed manufacturing overhead. Answer is the same. 27, don't need to worry. 28, 29, 30, 31. Okay. I'm not going to do it because it's just everything is just a calculation. Maybe I need to do it. Okay, the first one, I'll do it. Question 28. So volume variance. This is chapter 10 actually. So you have the actual, you have the flexible budget, you have the master budget. No, produced fixed manufacturing overhead. Okay, I don't think I will test you this one in the exam, but let's say actually produced 38,000 units. You actually produced 38,000 units, but your budget is 40,000 units. So your flexible budget is based on the actual, will also 38,000 units. And then if it's 40,000 units, it's $400,000. It's $400,000. So each unit is 10. Each unit is $10. Each unit is $10. So this is the price. Asking about your volume variance is your difference of flexible budget and the master budget. So the units difference is 38,000 minus 40,000, and then each one is $10 each. So that gives you $20,000 as the variance. $20,000 as the variance. And then your left side is lower than your right side, and it's the cost, so it's favorable. So it's favorable. $20,000 favorable. Okay. So next one, question 29, talking about labor quantity is AS and SS, right? Labor quantity. Your labor. So let's look at standard price. Standard price. Okay, $20 per hour, right? You actual work the 29,000 hour. Your standard budget is 5 hours for each unit, and then you made 600 products. Each one is $5. So that will be 29,000 minus 2,900 minus 3,000 times our $20. So will be $2,000 as the variance, and your actual is less than our standard, so it's favorable. $2,000 favorable as the quantity variance. You thought you will use 3,000 hour, you just use 2,900 hour. Next one, material quantity AS and SS. So the standard price is $15 each yard, and then your actual yard is you use the 6,100 yards. Your standard is you are thinking about 10 yards for one unit, and then hold on. Okay, so quantity variance, right? So this is for the units you used. Remember this one, you purchased 10,000 yards, but you used 6,100 yards. When you do quantity, you use the yards you used. When you do price, you use the yards you purchased. But I said in the exam, I'm not going to give you this hard one. So you use the yards you used, and then our standard budget is we made 600 products, and we thought each one we just use 10 yards. Okay, so you actually use the 6,100 yards, but you only budgeted 6,000 yards, so you have unfavorable. So it will be 1,500 unfavorable. Okay, my solution, those two questions, I flip them different way. So this question answer is actually goes to question 30. This answer actually goes to question 29. Sorry about that. Next one, labor rate. So it's AA and AS. AA and AS. Actual hours is 2,900, and the actual rate is, I don't need to calculate, it already told me. Total is 61,000 there. And then my standard rate is $20 each, So if I do the difference, I get 3,000 unfavorable. Okay. Lot of work. Thank you for finishing watching the video. Let me know if you have any question with chapter 11. Thank you.